In the current market environment of March 2026, several specific groups are benefiting from the interplay of geopolitical recovery, high energy prices, and domestic growth initiatives. Primary sector beneficiaries, upstream energy producers. Companies involved in oil and gas exploration are seeing improved earnings as crude prices remain elevated. Brent around $82 to $84 per barrel. Key names. ONGC and Oil India benefit from higher realizations, with every dollar increase in oil potentially boosting earnings by 1.5 to 2%. Defense and aerospace. Heightened global military spending and India's Atmanirbhar Bharat push are driving significant growth. Key names. Bharat Electronics, BEL, and Hindustan Aeronautics are seeing strong momentum from increased domestic orders and global demand. Metals and utilities. These sectors led the market recovery on 5 March 2026, supported by rising global prices and infrastructure demand. Key names. Coal India, up 4%, Nalco, up 5%, and NTPC are top gainers. Strategic and manufacturing gains, refiners and exporters. While high crude is a cost, certain refiners are benefiting from tightened global fuel supply, particularly after China restricted diesel and gasoline exports. Key name. Reliance Industries surged 3% on 5 March due to improved global refining margins. PLI-backed manufacturers. Companies under the Production-Linked Incentive, PLI, schemes, particularly in electronics and pharmaceuticals, are capturing high-value global supply chain shifts. Regional leaders, 2026 focus. North America remains the hub for the largest funds, though returns lagged slightly behind Asia and EMEA in 2025. Asia Pacific averaged a 24% return in 2025, the highest global regional average. EMEA, notable growth in London-based firms like TCI Fund Management and Marshall Wace. Financial ecosystem, large banks and NBFCs. Major lenders like SBI, HDFC Bank, and ICICI Bank are expected to see margin recovery in FY27 as loan yields rise and credit demand remains robust. Estimated 15% growth for major indices. Gold loan providers. Rising gold prices, above $5,200 per ounce locally, provide a valuation boost to the collateral and unhedged inventory of companies like Muthoot and Manappuram. In early 2026, the global hedge fund landscape is dominated by firms that successfully navigated the volatility of 2025, particularly those using multi-strategy and quantitative approaches. The industry as a whole reached record assets under management, AUM, with the billion-dollar club controlling roughly 86% of the market. Top global hedge funds by AUM and performance. The following are the leading private hedge fund managers based on 2025 performance and 2026 AUM projections. Millennium Management, currently the world's largest hedge fund by AUM, managing approximately $505.9 billion. It operates a multi-manager, multi-strategy model with over 330 autonomous trading teams. Citadel, a top performer with $445.96 billion in AUM as of mid-2025. Its flagship Wellington Fund is a major industry benchmark. Bridgewater Associates, founded by Ray Dalio, it manages roughly $171.8 billion. Its Pure Alpha Fund posted a record 34% gain in 2025, the highest in its 50-year history. AQR Capital Management, a leader in quantitative investing, managing over $160.52 billion. It was one of the fastest growers in 2025, adding nearly $20 billion in assets. D.E. Shaw & Co., a pioneer in systematic trading with $154.59 billion under management. Its Oculus Fund surged 28.2% in 2025. Man Group, the largest publicly traded hedge fund, managing $174.9 billion. Its systematic AHL funds are among the top performers in early 2026. Key takeaway points are energy and commodities as alpha. High crude oil prices, sitting near $83 a barrel, and gold surge past $5,200 are creating clear winners. Upstream oil companies and safe haven assets are currently the strongest performers in an otherwise cautious environment. The AI valuation gap. A sharp divide has emerged in the tech sector. While hardware and infrastructure firms thrive, traditional IT services, like Nifty IT, are facing a sell-off due to fears of margin erosion and structural disruption caused by generative AI. TQ for watching. For more latest updates, do follow Digital Drift.